Alright guys, I know I've promised to do a video like this for a while and I finally had the time to do it. This video is just going to be on steps on how to trade risk events. So I know this might be a new thing for you guys, trading fundamentals and actually trading the news. But there are certain things you want to do or you want to make sure that you are doing in order to have a very good win percentage rate when it comes to trading economic events. So I had to put all of these in simple steps and I'm going to be explaining them in details. So the first thing you want to do is choose the right events to trade. But I'm also going to be talking about the three of them, but I'm going to start with the first one. First thing you want to do is choose the right events to trade. And this is going to save you a lot of time and effort in trading because for the markets, we have a lot of economic events coming out every single day. So that's why you see me talk about the red folder events and also the yellow folder events on the economic calendar. So you want to make sure, or the first thing you want to do is separate the red from the yellow and also both of them from the ones that are not even high impact data. This is going to save you a lot of time and also a lot of effort when you're doing step 2 and also step 3. So yeah, I also put this in 3 different tiers: tier 1, tier 2, and tier 3 events. So the first one is the tier 1 event, which is actually the most important, the high impact data. So we have inflation data, and this inflation data can come in different forms, which is CPI for the US, the UK, and also Australia and Canada, and in New Zealand as well. But for the Eurozone, it's called HICP. So that's for inflation data. And then we also have the jobs data. So jobs data or jobs releases are not very important in all countries, but it's very important in the US, which is the NFP, like you guys know, the non-farm payrolls, and also the UK, Australia, Canada, and New Zealand. But for the Eurozone, the Eurozone is made up of different countries: Germany, Spain, France. Yeah, so jobs data is not really that important there. The reason is because we have different countries, but personally for me, I like to focus on inflation data for the Eurozone: Germany, Spain, France. Yeah. So another tier 1 event is the PMI data, which is the Purchasing Managers Index, and is very important in the US and the UK as well. And you see this in ISM PMI, S&P PMI, Flash PMI, and also the global PMI. Then let's talk about tier 2 events. So for the tier 2 events, we have the GDP, which is the gross domestic product, and it's usually released quarterly, which means in quarters after every 3 to 4 months. And it's mostly important in the US, the UK, Canada, Australia, and also New Zealand. So these are the countries that you want to focus on their GDP because most likely it's going to impact the market. So another tier 2 event is the retail sales data. So one thing about the retail sales data you need to know is it's very noisy. We can have the retail sales print for this month come out very high, and for the next month, you can have it come out very low. So that's what I mean by it's very noisy. It contains a lot of, to get the retail sales data, you need a lot of confluences, so to speak, or you need a lot of events to actually conclude on the exact retail sales data print. But it's mostly important for China and also the US. And another tier 2 event is the PPI, which is the Producer Price Index, and also the US PCE. So this one is mostly important in the US, the UK, and also China. And I'm highlighting these countries so you know the different ones that are important and you actually keep that in mind. So another tier 2 event is the business and consumer sentiment data. Example is the US Michigan sentiment data. We have the preliminary and the final. Another one is the consumer confidence data and also the IFO business climate for Germany. And the last tier 2 event is going to be claims. But something you need to know about this one is, or something you need to know about tier 2 events is that context matters. So what do I mean by context? So if we see the central bank speakers come out and say, okay, yes, we are finally confident that inflation is going back to target. Now I want to shift our focus to the labor market, or we want to shift our focus to GDP, or in this case, the labor market. And jobless claims obviously refers to the amount of people filing for unemployment, filing for claims, or filing for unemployment claims. So that's where jobless claims now becomes very important. So that's why I said context matters. So in this case, a usual tier 2 event will now actually become a tier 1 event because of the Fed's focus. So they are now saying, okay, yes, we are confident on inflation, we are good. We are not declaring the war over yet, or we're not declaring victory on inflation, but we are now shifting our focus to the labor market. So that's where claims now becomes very important. And as for the tier 3 events, these are the less important data. So you can actually do without trading them because they actually carry less votes. So in this case, we're going to be looking at the trade balance, mortgage application, inventory data. For the US, we have the housing data, which is the new home sales, pending home sales, and also the building permits. So these ones are honestly less important in my opinion. So I want to talk about jobs data now. I want to start with jobs data because we all know inflation is very important, which is CPI. So for the jobs data, I want to talk about the employment data for the US, which is the non-farm payrolls. But something you need to know, it's not only important to focus on the NFP number itself. You need to focus on the sub-components, which are the unemployment rates, average earnings month over month, and average earnings year over year. And in some cases, participation rate and also labor force participation rate. So these are the events, or these are the sub-components that you actually need to focus on, and not just the NFP data. Because when you have a lot of data points coming up like this, there is a high tendency for it to come out mixed. You don't want to be trading non-farm payrolls higher, and then you see unemployment rates coming out drastically higher as well. Because for unemployment rate, the higher it gets, the worse it is for the US, and the lower it gets, the better it is. So if we see NFP now coming out at 254K, like it is, or like it did right here, and then we see unemployment rates at 4.4, I'm not going to trade that because that's what's called mixed data. The markets are going to focus on, and the reason I don't trade this is because you don't know which of them the markets are going to focus on. They might say, okay, the amount of jobs that we had for this month became or was very high, but at the same time the unemployment rates grew. So that's technically mixed data. You don't know which one the markets are going to focus on. So personally for me, I like to stay away on that type of data. So the next thing you want to do after choosing the right events to trade, the next thing you want to do is analyze what is expected and also analyze what is priced. So this helps a great deal in preparing yourself. You want to be prepared for data. You want to make sure you collect your sources, or you want to make sure you analyze this data. And that means collecting different info to make sure you have a very good edge. And to me, this is the most important step. So I also made this into two separate parts, which is the economic data and also central banks. When you're analyzing data, these are the two events you want to analyze: economic data events and also the central bank events. So for economic data, you're going to be focusing on the consensus, the prior, the forecast distribution, and also the interest rate pricing. So these four, personally for me, helps me in building my analysis, helps me in preparing myself when it comes to data and when it comes to economic events. And here we take a look at the consensus versus the prior data, and we also take a look at the market's minimum and maximum expectations. And how do we do that? We focus on how these data events are arrived at, or how these particular data are arrived at, which is the forecast distribution. And then we also focus on the time series. So after doing that, we look at positioning and price action, because the reason why positioning is very important is because it saves you from unnecessary losses, in my opinion. You want to make sure you know whether a particular pair is stretched long or is stretched short. And the reason I do this is because you don't want to be buying at the highs. You don't want to be buying when price action has reached extreme high levels. You don't want to be buying at that. Or you don't want to be selling at the lows. What does this mean? You don't want to be selling when price has already gone 100 and 200 pips lower. You don't want to be doing that. You're going to be opening yourself for a lot of more risk, because where are you going to put your stop loss? So context matters, and in this case, I'm talking about positioning and price action. So another thing you want, or after the economic data, you're going to be focusing on central banks, and in this case, I'm talking about rate decisions. So I'm going to dive in deeper, but let's talk about the economic data firstly. So for economic data, I said you're going to focus on the consensus, the prior, the minimum and maximum estimate, which is the low and high, and we're also going to be focusing on the forecast distribution. So let's start with the consensus. So the consensus in this case is the forecast. The forecast is the average or the mean, or the consensus is the forecast in this case, which is the average of the market participants who are expecting or who have voted for this data to come out in different values, so to speak. And I'm going to show you how we arrive at the consensus and also all of them. So the first thing you want to know about the consensus is actually, this is the most important one. So if we see this printing above the consensus, so that means obviously this was higher than what, or this was higher than the average of what market participants were expecting it to come out as. I hope that makes sense. If you really don't understand this, go back to the video, go back to where I started from, and it will all start to blend together. So after focusing on the forecast, the next thing you want to do is focus on the prior data. And I actually put a side note on this one. I said the prior is very useful in an event where we're not provided with the minimum and maximum estimates, because there are some times where Refinitiv doesn't give us a forecast. We only have the prior to deal with. So it's also important because it creates a clear view relating to the time series. And you would understand what I mean by time series when I go in deeper as well. But that's why you need to know that the prior is also very important. So if you take a look at the forecast here, you can see that for NFP, markets were expecting this to drift lower from 142 to 140. So that gives you that idea that, okay, yes, majority of the market participants are expecting the NFP to come out lower than the previous. So that shows you, okay, this is where I'm going to be focusing on, or this is where I'm going to build my trade plan on for step 3. So after looking at the prior, the next thing you want to look at is the minimum and maximum, which is the low and high estimate in this case. So this gives you a range. It gives you a range to focus on, because like I said, the forecast is the average or the mean that is collected from all the market participants. We have, for the market participants, I'm talking about financial institutions, I'm talking about the banks. So these big guys in the forex market, they come out and they analyze, or they give their own view of where they see NFP going to come out as in this case in particular. So that's what I mean. The minimum and maximum estimates now is talking about when we have all of these market participants coming, which one is the lowest that we had? If in this case 70K was the lowest, so that's why 70 is the minimum. And from all these market participants, which of them came out the highest? So 220K was the highest in this case. So that's why the minimum and maximum is important. And something you need to note is that for the calendar, if we see the actual printing above the maximum, it's going to come out green, and it's going to have this spike here. So this spike means, okay, yes, it came out above the forecast, and it also came out above the highs. So something you need to know, another thing you need to know is for the minimum. If we see this actual printing below the market's low, it's going to come out red here, and it's going to have the red spike. So that's something you need to know. And I find it very useful for the Excel calendar, because it just kind of gives you this straight lookup. So when you see this coming out red with the spike here, obviously you know, okay, yes, this came out extremely low. It came out lower than the minimum. So that's when you want to hit the button and actually place your trades. So another thing we're going to be focusing on is the forecast distribution. So the forecast distribution in this case is what I just talked about. The market participants all coming together, giving their own view of where they see NFP going to be. So the forecast distribution forms the forecast, and it also forms the minimum and maximum. So I want to talk about the forecast distribution precisely. So I also give a side note here. The forecast distribution also helps to show you clear outliers in terms of market participants / voters. And this helps you to determine the best bang for your buck. And the reason I say this is because sometimes we often see a lot of traders focusing on the minimum and maximum. So in this case, or the reason why I put this side note is, you don't really need to wait, or you don't really need to always wait to see the data printing out higher than the maximum, or waiting to see the data print out higher than or lower than the minimum. Sorry, you don't want to be doing that, because if you do that, oftentimes you tend to delay a lot, and you most likely wouldn't even get very good trades, or you just be waiting and waiting, when with the forecast distribution here, you can actually see clear outliers. So let me talk about outliers. What I mean by outliers is this. So if you take a look at this blue line, this signifies the market's meridian, which is the forecast in this case, the average of all of them. So you can see a lot of voters are in this range, 113K, which is the median here. And then the high is the first standard deviation high, which is this one. And then the low is the line here at the bottom. So these names you see here are the market participants. We have the Citigroup, the Scotia Bank. We also have the Oxford Econ. We also have the DNB. So these ones, all of these are the market participants. And these are where they see NFP to be printing at. So I'm using NFP as an example here. So back to what I was talking about for outliers. So if we see a lot of these participants here going for 113K as the average, what do I want to do now? To create my trade plan, obviously, I don't want to, obviously, if we see NFP printing at this range, 113K, 114K, obviously, how do you think the markets are going to take that? I just want to give 1 second for you to try and make this clear in your head now. So if the markets are already expecting this to print as 113 and we eventually get 113, what does this mean? Would this surprise the market? No. Most likely, would I be taking the trade from this? No. The reason is because markets are already expecting it to print like this. So it's most likely it wouldn't even create any volatility. And what are you looking for? You're looking for volatility and a direction. So for me to want to see for me to want to trade NFP, it obviously has to come out above or below this meridian, above or below this meridian here. So that's where outliers come in play. So when I'm creating my trade plan, I want to make sure I go for outliers. So for NFP in this case, average here is 113, right? So if I want to trade this, I'll look at the forecast distribution. If we take a look at 130K here, we are seeing a lot of participants going for 130K. Same thing for 125K. And if I look at 150K, it's still the same thing. 160K and 164K as well. So I want to go for a clear outlier. So we are only seeing one bank here going for 180K. So that's why I said you don't really need to get to the market's maximum. 180K is a clear outlier. We only have one bank here. So that's a clear outlier in my opinion. And that's why when I was building my trade plan, I put the maximum threshold here at 180K. So if I saw 180K, I was going to put the trigger nonetheless. So this is for higher print. Then let's take a look at the lower print. So obviously here, the minimum is 0. But personally for me, I don't feel like we need to get there. 0 is extremely low. I don't feel we need to get there. So personally for me, I went for 88. The reason is because of this, or 80. We have a lot of participants here going. We have just three participants here going for 80. So if we see this drift lower from a lot of them going for 113K, we now see 80K. Most likely, markets are going to react accordingly. So in this case, markets are going to push lower. So that being said, I've already talked about outliers here, and I hope that makes sense. So after doing your analysis, looking at what is priced, next thing you want to do is build a trade plan that shows you the best outcome. I don't think I talked about what is priced here, but I'm going to go deep. I'm going to go deeper in that. So the last thing you want to do is build a trade plan that shows you the best outcome and that will offer you good profits. I'm going to talk about what is priced here now. So this was the trade plan that we built in Day Trading Academy. We often go for the dovish and the hawkish outcome and also the inline outcome. So let me start with the inline outcome. So most likely, if we see the data printing out like this, we are not going to be pulling the trigger. We're just going to be staying flat because that's what the markets are going to be doing actually. So we build a trade plan consisting of the dovish and the hawkish outcome. We go in details here. The reason why I picked the numbers, as you can see, I picked this number because it's below the prior and it's also an outlier. Same thing for this one, above the maximum, above the prior, and also above the FOMC projection for 2025 year end. So I put reasons behind why I picked these numbers. And yeah, this was our trade plan for NFP. And then for this particular NFP, we were focused on a hawkish outcome. The reason is based on positioning and also based on rate pricing, which I'm going to go in deeper. So for rate pricing now, this was the interest rate pricing before the NFP. I have a full video talking about interest rate expectations, how to use this table and how to use it to find an edge in the markets, because it's very, 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 very important. If the markets are already pricing in something and that happens, most likely we're not going to be seeing any surprises to the market. And what do you want to trade? You want to trade surprises. You want to trade what the markets didn't see coming. So that's what's going to give you the best bang for your money, or the best profits ever. So take a look at this table here. This was the interest rate expectations before the NFP. And let me talk more on this. So if you take a look at this, markets were up. This was after the Fed's already cut rates by 50 basis points. Sorry. So markets now were pricing in close to another 50 for the November meeting. And aside, as if that was not enough, markets were also pricing, or money markets were pricing in another or close to another 50 for the December meeting. And in my opinion, that was really not, it was really not necessary. The reason is because if you take a look at GDP, where GDP was trading above the 2%, close to even 3%. And that shows you that the economy is doing fine. And we're not really having a lot of bad or worse data that we're going to say, okay, yes, the economy is in a recession. We even had Fed Chair Powell come out and say the economy is nothing close to a recession. And we also had other Fed speakers. We have Fed Bowman, we have Fed Waller come out and say this. But markets were not even listening to that. Markets were not even listening to the Fed speakers. They were only focused on the data because, yes, they were justified to focus on data because that's what the Fed came out and said. We are going to be data dependent, focusing on the labor market. So markets left the whole thing for data to sort itself out. But back to interest rate expectations, we are seeing now that markets were fully priced in for a 25 and now leaning towards a 50. So most likely what you see, if they had actually cut by 25, that would be seen as hawkish, because it's going to be seen as a hawkish cut, because markets are already pricing in more than that 25. Because yeah, markets for central banks to cut, they do it in increments, which means they do it in 25 basis points. So either they do 25 or they do 50 or they do 75 or 100. So in this case, markets were already fully pricing in that 25 plus an extra. So you can see why that would be seen as hawkish. So this was the interest rate table before the NFP. And I'm going to show you guys something. Now, after putting up our trade plan for possible outcomes, we look at the charts, obviously, to mark key levels and also possible profit-taking moves. And that's why I talk about this. Different traders have their own view of technicals. And in this case, I'm talking about the Fibonacci, the pivot points, support and resistance as well. But personally for me, I focus on implied vol levels. You often see me say, okay, I'm taking profits if we reach this first implied vol level here. And what are these levels? They are just levels of dynamic zones of support and resistance. They are usually updated every single day. And they are calculated using the options market implied volatility. And like many trading tools out here that you see, the fibs, the pivot points, they are not as accurate or perfect, but they can offer you very good levels of support and resistance to add to your trades. So prior to the NFP, this was where we were prior to NFP. And I was looking at GBP USD for some fundamental reasons. I'm not going to go into that right now, but GBP USD was the pair I was looking to trade. And what happened was this. Obviously, I was hoping we had a pullback. The reason is because so I will have a good place to put my stop loss. So prior to the data, we were seeing this was how it was before the data. And then, obviously, now I'm going to talk about the entry. If NFP opened way below here, would I be looking to take an entry and have my stop loss here? Hell no. I was not going to be doing that. So I was going to be looking to take my position before it broke this support level, or as it was approaching the support level. So that's going to give me a very good risk to reward ratio, because this is where I was actually aiming in terms of profit taking. So this was my entry. So you can see I took it before it broke that support. And yeah, now I want to show you the rate pricing after the NFP. So you guys know we had an incredible news for that NFP day. We had NFP coming out higher. We also had unemployment coming out lower. And to make everything sexy, we had average earnings month over month and year over year coming out higher as well, as a surprise. So what you will see is this. We saw the rate pricing reduce from 33 to 27, which means fully pricing in 25s. No longer close to that 30 benchmark that we were saying. Now we're just saying 20. We're just saying 27 and 29, which means, yeah, close to basically Yeah, close to basically 50, 60 total basis points priced in thereabout. So now for context, I actually put this in a whole table. Take a look at this. This was before the NFP. This was after NFP, and this is where we are now, currently at about 5th of November 2024. So this is where we are now. Markets are not even fully pricing in that 25 for the November meeting. And even worse, money markets are doing what they usually do. They are not even fully pricing in the December meeting again. So you can see how they went from fully pricing in that December meeting at 33 basis points cuts to now just 20 basis point cuts, which means they are not even fully sure of a 25 for December. All right, so something very important that is worth noting is that you may not get these opportunities every single day. That's why you're a day trader. There are days where 5 times a week you get 5 big deviations from data, which will create very, very meaningful opportunities to trade. But there are also days where you will just get one, or there are also weeks where you just get one. So the best thing you need to know is not every day is going to be like that. So that's something you need to know as a day trader trading the economic events. Not every single day you're going to be getting these big, big, big deviations. But personally for me, not taking a trade is a win in my book. I had to learn that from someone, and I had to learn it the hard way. Forcing trades is not going to get you anywhere. There are days where you need to be patient to get these opportunities, and there are days where you know that yes, you need to actually stay away. That's why fundamentals or forex is not just a black book, or it's not just black and white. There are days where you need to make decisions for yourself. Every single day you make a decision to hit that button. We all know that. But there are days where you know, okay, yes, this is not the time to do that. This is not the time to put yourself at risk or put your capital at risk. Yeah, so that being said, after focusing on the economic data, the next thing we want to do is focus now on central banks. So in this case, I'm going to be using rate decisions. So for central banks, what you want to focus on is the rates, the interest rates currently, the central bank statement, the forward guidance, and also the press conference. And our main focus here is going to be looking at money markets expectations, which is the interest rates expectations last pricing, then looking at research and institutions and publications, and also central bank comments. So these outlook most certainly will give you, or will show you how to trade rate decisions. So I know a lot of you haven't traded this before, so it might be something new for you guys. But trust me, there are a lot of opportunities to get from this, especially when you know what you are doing. So after that, the next thing you want to do is focus on positioning and price action. So this one is very important, like I said, because it saves you from unnecessary losses, as you don't want to be buying at the highs or selling at the lows. So that being said, let's just dive into it. So after knowing what you need to focus on in terms of rate pricing, looking at prior central bank comments, looking at the research and publications, the next thing you want to do is analyze what is expected and also what is priced. So that being said, I'm going to be making reference to the FOMC meeting that we had in March 20th, 2024. So the first thing I want to say about this FOMC is that we usually get what is called the dot plot. We get the summary of economic projections. So this is released quarterly after 3 months. So what this contains is after the Feds or after they come out and give their interest rate for that particular month, the next thing they do is focus, or the next thing they do is provide the summary of economic projections. What this means is that they forecast what interest rate is going to be for that year, for the ending of that year, and also for the next 2 years, which is 2025 and also 2026. So that's what the dot plot, or that's what the dot plot shows, or that's what the summary of economic projection shows. So I'm going to start first with prior to the rate decision, and also at the rate decision itself. So this was the pricing that we were having February. This was the pricing that we were having at the beginning of this year. So if we take a look at this, markets were pricing in close to 113 basis points worth of cuts for the ending of this year, which means markets were pricing in 3 basis points, three cuts for the Feds this year. If you take a look at this was March, right? And this was December. If you take a look at this, 1, 2, 3, 4, 5, 6, literally 6 cuts, so to speak. But if you take a look at the ones that are already fully priced in, that's for the 6th, which is May. And also, yeah, I hope you understand what I'm saying, because right here in the interest rate probabilities, we have 1, 2, 3, 4, 5, and 6. So this is what the markets were already pricing in. And now let's take a look at how that played out. So at February, we had the CPI data. So you know what we talked about the CPI data. It's a tier 1 event, very, very, very important event. So what happened is we had NFP, so we had CPI coming out higher than what the markets expected. So what this did was change the probabilities, or change the implied basis points that was already priced in for the markets. So by March 11th, markets were no longer pricing in this 113 basis point cut. We're now pricing in 99. So it reduced close to 20 basis points cuts after we had the CPI back in 10th of February. And something you also need to note is this. So remember in the first one, we're having a hold here. So markets changed these cuts that we're supposed to have in May. Markets changed it from a cut to a hold. And something you also need to note is this, the percentage probability. So markets were pricing in 82% of a cut, of a hold for the March meeting. So then for the May meeting, they were pricing in 75% of a cut. So what happened was markets now changed from a cut to a hold for the May meeting, and they also reduced their probability from 75 now to a 68%. So you can see how this data impacts this pricing that we usually get. So after we had this updated interest rate pricing, what we saw was we had CPI data for March now, prior to the FOMC meeting. We had CPI data, we also had PPI data. And these events also came out higher. They came out higher than what the markets forecasted. So it was actually a hot marginal print. So what this does, obviously, is give strength to the currency, right? So what happened was, prior to the FOMC, after we had this hot data, hot CPI and PPI data, this was now the pricing before the rate decision. So from having 113 to having 99, we now had 74 total basis points priced in for the year, for 2024. So you can see the reductions based off of these CPI prints that we've been having. So for context, I want to show you guys the summary of economic projections. So this was the one they released back in December. So obviously the next one was going to be March. So this was what they released for 2024. They saw 2024 interest rate to stay at 4.6 for the end of the year, prior to the September projection that they have for 2024. So the September was 5.1. So now for this December, they are now looking at 4.6. That this is where interest rates are going to be. So I hope you remember that. And also the dot plots, I also made a video talking about the dot plots. So you need to go back to that video for reference. So markets were expecting this to shift from a 5.1 to a 4.6. So you can see a lot of participants here are staying on these levels. So markets obviously were expecting this to shift to a 4.6, right? So yeah, that being said, also, markets were now expecting, going into the FOMC, markets were expecting the Feds to also shift their statements, where they talk about their economic outlook is uncertain, and they remain entirely just usual central bank words and commentary. So what markets were expecting now is for that to shift. For the March meeting, or for the summary of economic projections, markets were expecting this now to shift from a 4.6 back to a 5.1. This was the projection that they projected back in December. But because of those CPI prints that we're having, we had two consecutive high CPI numbers and also PPI numbers. So what markets were now expecting was, okay, this was what they projected for December. So markets were expecting this 4.6 now to go back to this 5.1 that they had back in September because of the CPI print that we were having. So this is what markets were expecting. So I hope that it stayed fresh in your mind. And also for the statement, markets were expecting them to tilt slightly more hawkish and saying, okay, because of the CPI data that we've been having, we are going to hold rates, or we are going to keep rates, just typical central bank commentary. So that's what markets were expecting them to do, at least change their statement and lean slightly towards a hawkish environment. So after doing that, we now focus on the positioning and price action. After taking a look at rate pricing and also taking a look at the central bank statement and prior comments, we'll now take a look at positioning. So for context, this is how the DXY was trading after the CPI print and also after the PPI print. So you can see markets did their due diligence, and markets fully moved or fully priced in the dollar for preparing to the FOMC. So you could see it was very, very, very clear and very evident that yes, markets were now literally moving according to what they had already priced. They were expecting the Feds to be more hawkish and reduce their 3 cuts for this year to 2 cuts for 2024. So yes, that being said, after we've already analyzed what is expected and what is priced, now it was time to build a trade plan to show the best outcome and obviously to get more profits off this particular FOMC meeting. So if we take a look at this, the baseline expectation was that's what the markets were already fully pricing in. Markets were expecting that the dots will be revised to 2 cuts from 3 cuts, with 2 or 3 dots changes. So for a dovish outcome, let's start with the dovish outcome. Markets were expecting the Feds to stay or to leave rates unchanged, with 3 cuts still projected for 2024. Because after having those CPI and PPI data, you would expect the Feds to come out a little bit more hawkish and say, okay, yes, because of this data that we've been having, we're going to be keeping rates higher for longer, which means we're going to be holding rates the way it is till we are more certain that yes, we can actually start the cutting circle. So for a hawkish outcome, this is what we're actually looking for. But personally, for me, I wasn't looking for a hawkish outcome because of the way the dollar was already stretched going into the FOMC event. So, but for a hawkish outcome, this is what we're looking at, because obviously you want to prepare yourself for either direction because they can always surprise you. But from what markets were already expecting, which is what for them to revise to 2 cuts from 3 cuts, and also the dots to also show that the hawkish outcome that we were expecting was an upward revision to just 1 cut. So obviously that would be seen as hawkish. All the way from 3 cuts that they were projecting to just 1, that would be seen as hawkish, right? Then for a dovish, we're hoping to see that they will leave the 3 cuts and leave rates unchanged. And also for the PCE and the inflation data, we're hoping that yes, there will be a slight upward revision. Now, this was the market expectation. There will be a slight upward revision. And also for the statement and language, well, markets were expecting them to just have subtle changes in statements and also the press conference explaining the shifts in the dots, and that they are more patient and they want to see more data to actually know where they stand. But for a dovish outcome, what we're expecting is they will leave statements unchanged and just basically say that they need more good inflation prints before they can start cutting rates, obviously. Then for a hawkish statement, clear shift in statements and press conference, that recent inflation data has spooked them, which means has made them want the need for more patience, and is more larger now prior to what it was because of the high inflation data that we've been having. Okay, we are going to take our time. Now this has made us come together now and talk more about what we really want inflation to be. So this is going to take more time, And so we need to be patient and see that inflation is actually drifting lower before we can actually cut rates for the year. So what we're focusing on was a dovish outcome because of the pricing, and also, yeah, that was just our expectation, a dovish outcome. So what happened? This was the outcome. They left rates unchanged with three cuts still projected for 2024, and they also left the statement unchanged. So obviously, what do you think that will mean for the DXY? So I want you to just take your time now and reason with everything I said. How do you think that would impact the DXY? So let me come again. Markets were expecting the dots to be revised from three cuts that they had already projected to two cuts because of the hot CPI data that we've been having. So what happened was they didn't do anything. They left the December, they left everything unchanged with three cuts still projected for this year. And in what that means is that the Feds were not even concerned about the hot CPI number that we're having. They didn't make any changes in their statement, and they left the dots the way it was at 4.6 interest rates. And for more clarity, this is what it means. You remember for the December projection, we were having 4.6 and 5.1, and the markets were expecting them to shift their projections now from that 4.6 to a 5.1. But this is what happened. For 2024, interest rates were meant to stay at 4.6. So this was the summary of economic projections that they did, 4.6 and 4.6. So you can see how that reflected in the chart as well. From overall having that hawkish projections to now having very dovish sentiment when it comes to the dollar. So that being said, I hope that really makes sense. And I try to go in depth and talk more about how to approach these events, because you need to plan and you need to execute. That's why I made sure to go deep into each and every step. So you can always watch this video as many times as you'd want, because that's the only way that you would actually get to understand how to trade economic events and how to use context to your advantage. And always remember that it takes time to grow. Rome wasn't built in one day. And personally for me, showing up every day will help you gain more experience with the markets. And one thing that I also need you guys to know is to grow at your own pace and always ask questions. You see a lot of gurus come out online and say they did this or they flipped their accounts from this to this. They did this from this to that. Please, guys, grow at your own pace, because it's your own journey. It's your own capital. No other person is going to be held accountable. It's just you. So you need to make sure that you do this at your own pace. But always ask questions, guys. It's always good to ask questions. And I'm also going to leave this with you guys. Your journey to success is a marathon, not a sprint. As always, guys, if you have any questions, please let me know.